Your tax bill is one of your top 3 expenses in retirement. And if you can learn to lower your lifetime tax bill, that will give you more money to spend in retirement. You'll learn today 3 ways to lower your lifetime tax bill. But first, you need to understand the principle behind lowering your taxes. Now, I just spoke to the Wisconsin Institute of CPAs, ran this idea past them. They all agreed. And that idea is that you need to pay your taxes when the rates are low. You need to avoid paying taxes when the rates are high. So keep that in mind as we go through 2 different ways to go about paying your taxes. The first being, what if you don't do any tax planning at all? The second being, what if you actually do go ahead with some tax planning? Now, the overall taxes in these 2 scenarios was cut almost in half, from $329,000 to $172,000 in a projection over that lifetime. Let me show you how we did that. Now, the first way to lower your taxes in retirement is to use Social Security to lower your tax bill. You might not be used to hearing the idea of Social Security and your tax bill going together, but Social Security is taxed differently than a lot of other income, and using the way that Social Security gets taxed can add a lot of value to your retirement. I'm going to give you an example where we've got a couple, 62 years old. They have $1 million in retirement savings. The one person has $2,500 in their Social Security. The other person has $1,500 in their Social Security. Those are their promised benefits at the age of 67, their full retirement age. Now, when you have just one person wait from not just 62, which is quite common to file for Social Security then, but actually wait to 65, I see about $87,000 in extra Social Security being paid out to them over a lifetime. If that person waits even further to age 68, I see a total then of $317,000 extra in Social Security over a lifetime. Now, that might be a reason to file for Social Security later, but what happens when you're filing for Social Security later is now you have more time where you don't have the Social Security coming in, and you don't have the way Social Security gets taxed coming in. Waiting 3 years or maybe even up to 6 years, whatever works best for you, waiting that extra time to file for Social Security gives you extra time to do Roth conversions. I took a look and found that there was $56,000 in tax savings by not just waiting on Social Security, but waiting on Social Security and using that time that you're waiting to do those Roth conversions. That was an extra value by waiting. So think of Social Security, not just how long am I going to live, how do I get the most out of Social Security, but how do I use that time that I might be waiting to lower my lifetime tax bill. Now, the second way to lower your taxes is to rearrange your charitable giving that you're probably already doing to get more deductions. Back in 2018, when they doubled the standard exemption, a lot of people that were itemizing their deductions can no longer itemize anymore. Yet if they just rearrange how they're going about doing that, they can probably go back to itemizing at least every other year. Let me show you how that works. Imagine you are giving money to charity this year and next year because you're consistently doing that. Let's say it's $10,000. And when you have your state and local taxes, that can show up on the itemized deductions. That's $10,000 as well. Perhaps you have some medical expenses that you get to deduct, and perhaps you have some mortgage interest that you get to deduct. Well, the standard exemption is roughly $30,000 for a retired couple. So you've gone through and given money to charity, paid the taxes, have these expenses that you think are deductible, and really they aren't really helping you out at all, right? They added up to $30,000, but guess what? The standard deduction is $30,000. So your donations to charity, which are amazing and wonderful, did nothing for you tax-wise. So just imagine, though, that you take the charitable deductions that you're planning on doing next year, and you did them this year, right? Somehow you gave $20,000 to charity this year. Perhaps you give a lot of charity in January, and you're planning on doing it again in January, but instead you do it in December. So you have the same amount to charity, $20,000 this year though, 0 next year. Well, 20 plus 10 plus 5 plus 5, that equals 40. And in the world of taxes, 10 plus 5 plus 5 also equals 30. So you went from having 30 of deduction standard, 30 of deduction standard, to now 40 of itemized deductions, 30 of standard deductions. Of course, I'm rounding for all this, but that gives you $70,000 total instead of the $60,000 that you would have had otherwise. That's an extra $10,000 of deductions every other year. If you're in the 22% tax bracket, that's $2,200 of tax savings. So rearranging how you go about making your charitable deductions, the timing of when you make your charitable deductions is a great way to do that. Now, a second piece of that, if you really want to turbocharge that, is to do something called a donor advised fund, where a lot of times when you give money to charity, and if all of a sudden this year you just doubled how much you gave to charity, and you're planning on not giving that money to charity next year because you already kind of doubled up this year, the charity might think, do you not like them anymore? You skipped a whole year. Or they might think, hey, you doubled the amount to charity this year. Maybe you'll double the amount next year. So a lot of times what you're looking for is to keep the money that you're giving to charity consistent, but it's your tax deductions that you want to push into 1 year. And this donor advised fund is a great way to do it, where perhaps this extra amount that you gave to charity this 1 year just goes to that donor advised fund. You get the deduction because you have committed that money to charity, but then you can keep having that money be sent out monthly even from that donor advised fund. So it's as if the charity doesn't see anything different in their cash flow. It's just you're choosing when you pay the taxes so that you get the tax deduction all in 1 year. To turbocharge that even more is you could give stock or mutual funds that have long-term capital gains, where this amount of stock you might have bought for $5,000, now it's worth 10. If you sell it, that's a $5,000 capital gain that you'd have to pay taxes on. But you could gift the full $10,000 of stock, get that $10,000 deduction, and that gain that's sitting there that you would have paid taxes, you don't have to pay the taxes on right there. So as you're going through and bunching your charitable deductions and throwing them to 1 year, see if you have any non-IRA stock, non-IRA mutual funds with a large long-term capital gain that you can use to gift to that donor advised fund. Now, the third one is only for people that are 70 and a half. When you're 70 and a half, you can make use of this rule called the qualified charitable distribution. QCD. QCD says you're going to take money from your IRA and you're going to send that directly to the charity. When you send money from your IRA directly to the charity, it avoids showing up as income on your tax return, which helps you with the formulas they use to figure out how much extra you might pay in Social Security taxes and how much extra you might pay in extra Medicare costs, in the dollar amount that you use for deciding how much of your medical expenses are actually deductible. So it's very helpful if you can lower your income doing the things you would have done anyways. Imagine if the money went from the IRA to you to the charity. It shows up as income here. And as we just learned, a lot of times your charitable deductions don't actually get taken away as a deduction. So if you can take yourself out of the equation and have the IRA go directly to the charity, that helps to lower your income, helps to support the charity. And it's still 70 and a half that you can start using that qualified charitable distribution, even though the RMD, required minimum distribution, doesn't come into play now till 73. So it's now a separate number. It used to be the same number when they forced you to take the money out and when you can use that qualified charitable distribution. So if you start using this idea now at 70 and a half, it helps lower the amount in your IRA so that later on your required minimum distribution is also lower. And of course, keep on using that qualified charitable distribution when you hit 73, because you have to do those RMDs, required minimums, and the qualified charitable distributions, QCDs, that count as well towards that. So that helps you satisfy the requirement while you're having a lower amount show up on your income. Now, I go into even more detail on the specifics of how to go about with each of these ideas at paylessretirementtaxes.com. So make sure to check out paylessretirementtaxes.com. Now, the third way that you can lower your lifetime taxes is to use Roth conversions to lower your tax bill. Now, I hear a few things when it comes to Roth conversions, and one of them is, I can't do a Roth conversion. I've got so much money in my traditional IRA. That'd be such a huge tax bill. I don't want to pay that huge tax bill. Well, you don't have to convert the entire Roth amount. You can choose exactly how much you want to convert, and you can choose exactly when you want to convert it. Remember that principle, where the principle is when your tax rates are expected to be low, you want to pay taxes then, and when tax rates are expected to be higher, you want to avoid the taxes then. So I'd encourage you to project out, plan out exactly how your taxes are looking. And when you do that, you'll quite often see, okay, I've got some times when the tax rates are actually lower. Go through and figure out, all right, that's your tax rate. That's the amount of money that you have at a certain tax level. And you can get that exact specific dollar amount to go from the one area to the next area with that Roth conversion. So you can tell your IRA custodian, the place where you have your IRA money, to go directly from your traditional IRA to your Roth IRA at the exact same dollar amount, the exact dollar amount that you want. But that's only after you've gone through and said, okay, these are the lower tax rate times. I'm trying to avoid the higher tax rate times, and this is the exact dollar amount to do each and every time. Now, while you're lowering your lifetime tax bill, don't overlook the other parts of your retirement. So check out my next video, the most overlooked aspects of retirement. I'll see you there. Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.